like BHP with the one Chinese one pricing. You had Rio moving to fast markets. You had Fortescue had cargoes held. What's happening in the world of iron ore shipping and paying at the moment? Is it affecting you at all, or your customers are pretty stable?
Yeah, Matt, I get this question a lot because obviously it's a key focus of what media is interested in iron ore, and my point would be not nearly enough given the scale.
Right here, mate. Right here.
I'm really glad you asked that question.
This is general advice and my opinions only. This episode's company has paid me for this interview. I may be long, short, or hold an interest in stocks or CFDs mentioned. Past performance isn't reliable. The interviewee's views are their own, not necessarily mine. LEVRD operates as a corporate authorised representative 00131 8377 under AFSL 548573. You can find our financial services guide via the LEVRD website link in the show notes.
We're heading back to the red dirt, the royalty payer for WA, Fenix. Johnny Welborn, mate, the chairman. Great to have you back on one of the inaugural company episodes I did, and looking forward to a follow-up. How are you, mate?
I'm good, man, and I hope you've been supporting and buying every stock you've done since that early days.
Oh, mate, well,
appreciate your support of Fenix.
Yes, mate. Before we get into the stock price, old Shawnee, our good mutual friend Shawnee Russo, gave you a good mention in the episode we did the other week of you. Just an un-iron ore question, your Resolute days when you held on to gold against the grain. I wanted to ask, did you get flack for it when you were doing it?
Yes, I did. One of the things that surprised me about gold investors is that they're very happy to have exposure to gold in the ground. If you define it and you have high-grade gold and lots of it, they'll value it in the ground. But the moment you do all the hard work of extracting it, refining it, and turning it into a doré bar, they want you to vaporize it straight away. Somehow it has huge risk if you're holding on to as the period you're referring to, we built up a big bullion balance. And it was seen by investors to have an unnecessary exposure to the spot gold price. Whereas as a gold miner, I assumed that people investing in us wanted positive exposure to the gold price. And I'm not sure Sean supported the strategy at the time, but as he will admit, it ended up paying off quite significantly for Resolute shareholders.
He chickened out. He said he agreed with you at the time. Maybe that's not true. Maybe the truth's in the middle somewhere, is it?
The great thing about economists is that no matter what they talk about, they'll say, look, we could see quantitative easing, and in that case, the Australian dollar will go up, and otherwise there might be some trade imbalance that sees pressure on it. And in a year's time, they'll tell you they got it right, whichever way it moves.
Very good, mate. Let's get into quick plug for Mine and Select listeners. If anyone gets sacked from their mining job, go to Mine and Select. That's where you get a mining gig these days. Take it over, seek. Like Johnny's about to take over the WA iron ore business. Mate, got it up on screen here. With the war and everything, last time we spoke, you're sort of coming out the back end of you had the cyclone, there was the commencement of potential diesel shortages, which did impact you guys. I think you were trading about 33 cents, sort of tracked back down to 26 now, but as I show on here, like this was your revised guidance, but you're doing everything you say you're going to do. Is it the war going on, that's sort of seen a bit of a downtrend in the share price? Where do you put your finger on it?
Well, look, the slide you're using is a good one to say we had a fantastic end to FY26, record quarter everywhere. And when we talk about meeting our revised guidance, I'd make the point to any listener that was revised upwards during the year, not a lower target. We actually met near the midpoint of our upwardly revised guidance. And importantly, from a cost perspective, we maintained our guidance, and that's the same cost largely that we had in FY25 into FY26 and now guiding the same in FY27. Fenix is going gangbusters. You're right that the share price is moving in the other way. And internally, we're just focused on getting the job done. And we're very confident that the numbers we will produce, we're focused on building a bigger business in revenues and in earnings, in scale. That allows us to have bigger margins as cost comes down. And when we do that, the market will reward it. It's not coming through in the share price at the moment. I'm sure you don't have anyone sitting on this side of the screen, Matt, saying that the market is overvaluing their company. So along with every other CEO, manager, director, chairman of a listed company, I think that the market is yet to catch up in value. But that's also the opportunity that investors should look for. As I've said recently, great fan of Warren Buffett's be fearful when others are brave and be brave when others are fearful. Iron ore is an interesting place at the moment. It's a huge global business. If you look long term, it's on the up and up. We remain very focused on building a big iron ore business, and we're confident we'll get rewarded in due course.
If the world was normal, like if fuel prices didn't go up, you didn't get a cyclone, trying to get my head around what this business could do if the world sort of resumes to normal. Like just like year on year, cash is up. Obviously, you went down 5 this quarter. What should have it been if all that crap didn't happen, do you believe?
Well, I think we would have been, our C1 cash cost was $80, let's call it, in June, but the shipping price was probably another 10 or even at times $15 Aussie higher. So we potentially could have made $20 more. In the glory days of Iron Ridge, we were making 50 Australian dollars cash flow a tonne on albeit lower tonnes. So given, we moved 1.3 million tonnes, if we were making operational cash flow of $50 a tonne on that, you would have seen the operating cash line be $50 million more. To put it bluntly, we obviously, a lot of people appropriately, if they're bearish on iron ore, look at, well, what happens to Fenix if iron ore goes down to 90 to 80 US dollars a tonne? The question you're answering is what happens if, as we've seen on 2 or 3 occasions over the last couple of years, it spends any time at all at 120 US. Well, that's $30 a tonne on, let's call it 1 million tonnes a quarter more. So basically, the answer to your question is, well, you can double that operating cash flow line and it goes directly to our bottom line. People who followed Mount Gibson when they were mining at Coolin, they were mining at about 4 million tonnes per annum. They enjoyed a relatively short period of high iron ore prices, and they banked $400 million. So yes, there is a really exciting upcase scenario for Fenix. If we see high iron ore prices, given the scale of our current business, we're going to have a really, really bonanza period of time. However, we don't run the business like that. You see that we're conservatively hedging on iron ore, we're hedging on the iron ore price, we're hedging on diesel, and we're making sure that we earn the right to build the big, sustainable, high profit engine that we know is in front of us.
Any sort of global changes to the iron ore macro scene since we last chatted? Any big catalysts?
Well, I think it's just dipped below 100 US. So that would be one cause of share price weakness at Fenix. We're at $97, $98. That's around our budgeted iron ore price. So we're quite comfortable operating at those levels. I think on the longer term macro, I continue to be buoyed by the bullish sentiment that investors have for copper, for nickel, for tungsten, for a range of metals that are exposed to drivers like energy transition, increased military use, increased reconstruction efforts, and decarbonisation efforts. All of those things are a derivative of steel, and so I don't think you can be bullish on any of those metals without at the same time being bearish on iron ore. We continue to see a very strong pathway as we increase our volumes and as we bring our costs down.
Yeah. Now, got it on screen here for those who don't know. Your iron ore west of the gold plays in the Murchison's, the best way to describe where Weld range, which is the future of Fenix. So I guess the quarter looking looking at the numbers, like you've ripped from what 974,000 tonnes in the March quarter, and you've done 1.3 million tonnes this quarter. So what has actually driven that big uptick? Because that ain't shy, and considering the challenges you had early on in it.
Yeah, so look, well, yes, exactly. A real testament to the strength of our team. We had nasty cyclone Narelle at the end of March. That caused a lot of water, rain, both in our mining pits and also on the roads of Geraldton, and closed down the port of Geraldton. So we had a big challenge around a unified push across our business to make sure that we made guidance. And we got there by having the record that you have just referred to. But the tonnes you're talking about are the tonnes we shipped. And that was a 35% increase on the March quarter. However, if you look at across our business, we run a mining operation, we crush and screen, and then we haul our ore 500 kilometres and we store it at Geraldton, and then we ship it to our customers. If you look quarter on quarter at ore mined, and particularly ore processed, you get a more consistent picture. So I think actually, ironically, in the June quarter, we actually went, I think, almost down in ore mined and ore processed. Where we outperformed was in our haulage business and in our shipping business, where we had a significant increase. And so that was really around, we've only recently integrated all of those businesses together. We talk about operating an integrated supply chain, but it's actually in the last quarter that we've really seen the benefit of having one unified management team operating the mining business, the haulage business, the port business, and now our immature shipping business. With one outcome in mind, which is to maximise efficiency. And so that's what resulted in that, in the very, very big increase in our tonnes hauled and our tonnes shipped. But actually, our mining operation was quite consistent quarter on quarter.
Yeah, and we'll get into the new partnership you got for the shipping now. That was probably the last leg of things you could get a partnership with. Because your exit run rate was, effectively 5.2 million tonne shipped. You've got guidance for next year coming out at 4.7 to 5.3, so 5 million tonne sort of midpoint. Is that, considering the challenges you had, you did hit guidance, you did revise the guidance upwards. How would you describe this guidance for FY27? Are you leaving a bit of fat in it? Can you sleep well, John?
We always stretch ourselves, and we aim to be quite conservative with the things we can't control, the iron ore price, the exchange rate, the fuel price, but relatively aggressive with the things we can control. We back ourselves to be top performers. So the answer to your question, Matt, is no, we're not padding it. You're right that we hauled and we shipped ore in the June quarter at a run rate of about 5.5 million tonnes. And so therefore we'd say, well, why? You're dropping back, taking it easy, getting to 5. However, again, if I point you towards the ore mined and ore processed, I think in the June quarter we were roughly, or 1 million, tonnes on ore mined and 1.1 on ore processed. So times that by 4 and you see we've actually got a bit of work to do with ore availability. And that's part of that transition, the closure of Shine, the closure of Iron Ridge, and the ramping up of our Beebyn Hub. So that to actually get the 5 million tonnes, we've got to mine at a higher rate than we have. And that's the gap. So the haulage team have proved that they can run at 5 million tonnes per annum. And we've got the fleet, and we know those guys can perform. And the port, we've shown that we can do 5 million tonnes per annum, but we're yet to consistently run our mining and particularly our ore processing at 5 million tonnes per annum. That's the target for FY27, and that's what investors should watch, and that's what we're backing to get to.
How you feeling about the wind down of Shine, the ramp up? You're effectively starting the Weld range project. We'll get in the W10 approvals soon, but is mining the big focus and the bottleneck at the moment? You feel like the haulage and the port side's running smooth enough?
Yeah, we have, it's very consistent operations in haulage and port going from FY26 to FY27. As I've described previously, look at our 3-year plan. We're now 1 year into it. We've been very clear and consistent with that market messaging. It hasn't changed. And it looks very consistent, effectively, as you have done, choosing the midpoint of guidance. We're going from 4.5 to 5, and then FY28 will be at 5.5, aiming for 6. That looks very consistent. But what's actually happening in the background is we're going from running 3 separate remote mines, Shine, Iron Ridge, and W11. And at the end of this financial year, we'll be operating 1 mining hub. And so there's a lot going on in the mining business. We're building a new crusher. Ultimately, that crusher at Beebyn Hub will be capable of doing 6 million tonnes per annum. And so the finish of construction, the commissioning of that crusher, the ramp up of our mining activities at Beebyn as we successfully, there's a real skill in starting mines, we've shown that. There's also a skill in safely and efficiently closing mines. We'll do that this year at Shine and at Iron Ridge, and that's a really key focus for FY27.
I'll get on the costs after. I'll stick on Beebyn Hub at the moment because the approvals got secured for Beebyn, so W10 at Beebyn. So that's the key regulatory and environmental approvals. But there's the question on the native title side of things. So the Wajara Yamaji deed of covenant for W10, so that's still being negotiated. So if you've got that native title agreement, these approvals that you've got, is W10 effectively mine ready yet, or still contingent on that covenant coming through?
No, it's not. But before I'll talk specifically about our relationship with the Wajara Yamaji and the crucial approach to native title we've taken. But before we skip over that approvals, I just want to congratulate everyone in the team, Goran Seat, Chief Development Officer of Fenix, and also the mining team. Getting approvals in WA is a great mining jurisdiction, but the ability to meet your timeline objectives on approvals really is a skill set that requires a lot of exigence, and we're really pleased to have actually got this ahead of schedule. We're now clearing, we're now starting mining. So the answer to your question is yes, we're getting mine ready at W10. We know we've got all the approvals in place, and that is a focus on environment, on heritage, and on all of the other technical requirements to meet the department's requirements. So we're pleased to continue that track record that we've had at our other mines with the Beebyn Hub. In relation to the Weld Range project, we have an exclusive 30-year right to mine on tenements that are owned by Sinosteel Midwest Corporation, 100% owned by Baosteel, the largest steel maker in the world. Investors may remember the huge focus, the more than $1 billion that Sinosteel and others have invested in the Weld Range and Jack Hills developments and the Oakajee port and rail network. That part of the Sinosteel approach was to negotiate and sign a heritage agreement which includes the Weld Range.
Yep.
So the tenements that we mine on, we operate under the Sinosteel heritage agreement with the Wajara Yamaji. And so we don't need any further heritage agreements in order to mine W11, W10, or any of the other Ws on that. That's a good page to talk to. However, we have our own relationship. Iron Ridge was a tenement and a mine that we started ourselves, and we negotiated our own agreement with the Wajara Yamaji. And that had some very specific elements to it in the relation to our employment practices, our heritage officer activities, our cultural significance training, and other aspects that we wanted to continue into our Weld Range mining agreement. That's why we negotiated for W11 a deed of covenant, and we're doing the same for W10. It won't slow us down. It's not actually required. We're actually operating under the Sinosteel agreement. What the deed of covenant does is it puts extra obligations on Fenix and allows us to replicate some of the arrangements that we had in place at Iron Ridge and at W11 and at W10. And so it's something that the Wajara Yamaji and Fenix are mutually eager to continue as we mine these ore bodies. It's really around our agreed conduct in mining, and it sets it effectively is a convention that regulates how we're applying the existing native title agreement to our mining activities. So hopefully that makes sense. We're very committed to that relationship. It won't slow us down.
No, that's good. Anyone would be like, he's avoiding this, but that gives perfect context around that question, mate. So I appreciate that. I understand that a lot better now. So, and because there's a lot of that around, the duty to employ a lot of a certain amount of Indigenous people, like good community relations, the employment. Is that like the big driver of having them involved in Weld Range as much as possible?
Yeah, Bill, it's also essential. There's actually an enormous amount of heritage. We know that anyone who's followed Iron Ridge knows that ore body is actually a lot bigger than the amount of material we're going to move, but it is constrained by heritage. And the ability to mine the ore body successfully, as we've done, has been intrinsically linked with having traditional custodian representatives on site, so that when we discover sensitive areas, we can act accordingly, seek guidance. It's not something that we sign up an agreement and put it in a bottom drawer and forget. It's actually a daily activity. We did vibration monitoring for until we mutually decided that it was no longer necessary. And fortunately, we're moving away from sensitive areas as we get into Beebyn W11, W10. Compared to Iron Ridge, there's not nearly as much impacted heritage in the Beebyn hub, but we're still maintaining the same relationship, the same focus, and we want to continue to have very close daily interaction with our traditional custodian representatives.
So I guess it's just a reminder for investors that look at numbers for companies and disregard like the amount of work that goes into doing it properly and getting it done, that you know, a lot of companies, you don't get credit for it by the general investment community. It's a critical path for Australian mining.
Yeah, but I think that's when you see that we've got W10 approvals, native heritage title is just one aspect of that. Yeah. So, you know, similarly at Shine, at Iron Ridge, at W11 and W10, we're now stacking up a track record of being able to say when we think we're going to approve, get something ready to go, and then getting it ready to go on time. And yes, you're right. There's not one thing those. Any delay, you find a sensitive species, 6 months worth of work required potentially. You have a breach of a term in your native title agreement, well, you can expect therefore to get significant delays on the next approval. If you have non-compliance issues with the department, then you're not going to have a speedy processing of your applications. So I think we're continuing to focus on that, and it continues to pay benefits for us.
So because W10 first blast is scheduled this quarter, and you got W11 doubling to 3 million tonne per annum. So like in this next 6 months, what's the critical path for all of those things to happen? What are your big ticket items?
Well, we're already starting the ground clearance activity. W10, as you can see, even at this scale of map, but if you look at a photograph, they're effectively side by side. So in fact, when the pits are completed, they actually kiss. So effectively, it's one mine with two areas. So in terms of the usual timelines and risk on establishing a new mine, this is effectively one crushing area. We've already started the Beebyn hub. I think the key focus looking forward on that timeline is not so much first blast, it's the commissioning of the new crushing plant, getting that up and running in a time frame that is aligned with the increase in ore in the Beebyn hub. A big kicker for you guys to get cost downs, this haul road, 244k haul road, correct me, where is that it along there? So the dotted line is the rough estimate of where the Oakajee rail corridor.
That's the rail. Okay. Yep.
Design. Yeah. So that's a 4 kilometre wide logistics corridor that had previous environmental and heritage clearance where the Oakajee Railway was going to go. So our plan, as outlined in the scoping study, and will be detailed further in the definitive feasibility study that we're targeting to complete before the end of 2026, is to use about 60 metres of the 4 kilometre width to build a private haul road from the Weld Range all the way to where you can see north of the Riverdini Inland Port label and that little rail symbol, where it crosses that road that goes to Murchison. Yep. We're then going to build the private road alongside that Shire road right into the back of our Riverdini rail siding or Riverdini Inland Port. So that will connect on an entirely private road, the Weld Range, directly to our rail siding and inland port. Yep. And then from Riverdini, we have the option of either hauling those tonnes in the same way we do at the moment on our public road trains, or transitioning as we intend into efficient rail directly into our sheds in Geraldton.
Mate, getting into the big timers when you've got trains.
Yeah. Well, so we've transformed the business from being a single 1.5 million tonne a year miner to now a 5 million tonne a year miner. And there's a further transformation in terms of hopefully the impact of that should be really obvious. One, it cuts 100 kilometres off the haulage route, so 20% cost saving just in distance. Two, it allows us to use much heavier gear and be more efficient because we're the only user of a piece of infrastructure we'll own. And three, it does transition us onto the rail for that last built-up 100 kilometres. So there's a whole lot of efficiency around that logistics, and that is the key element that will see us lowering our costs from the mid-70s, C1, Aussie dollars, FOB Geraldton, to mid-50s.
Yep. That is the big kicker, because I think looking at the money, like the revenue, so bloody hard work, like 294 mil of revenue in the half for 9.7 million tonne profit. So dropping this C1 from 70s to 50s, I assume is like, a pretty big game changer in the future.
Well, it goes hand in hand. Obviously, the way you make money is have volume and then have a margin. And so the best way to increase the amount of profits you're making is increase your volumes and bring your costs down. And that's regardless of the commodity price. So yes, that's what we're excited about. And we're proud to be a profitable iron ore miner. We pay a dividend. And we're self-funding our growth. As I point out, we last raised equity in 2020. We raised $15 million, which was the capital we'd identified we needed to build Iron Ridge. We haven't raised any equity since. And so all of the acquisitions of the rail sidings, the increase in our port assets, the increase in our fleet, the establishment of new mines, all of the assets you see in Fenix, we've funded out of operating cash flow. And so that profitability, that increase in revenues is unusual for what is a growth project. And yes, we are very excited. We do see ourselves generating significant cash flows, significant profits, and being a much higher value mining company when we get to a much higher volume, lower cost business.
And because I think like last year you paid a 1 cent divvy, which I think was 147% of your profit. Like, I guess with what's coming up this year, the numbers I've got, like 40, 50 mil of fleet, 110, 120 mil of growth capex, with 81 million cash, and then you've got the 20 mil to go out the door to Sinosteel in September. Like, is dividend still on the cards this year, or does some of that stuff get deferred maybe to do it, or is sticking to that dividend a big part of the business?
Look, the ultimate decision to declare a dividend is one the board will make when we look at the full year audited numbers.
Yep.
However, I'm very happy, Matt, to say that we are committed to our dividend policy. The fact you're pointing out that we have an ambitious growth agenda, and we know we've identified when we published the scoping study that we think we can generate roughly $200 million of the 500 we need from the successful positive cash flow of our operations. That obviously depends on the iron ore price and our ability to control our costs as we're demonstrating. But that leaves a $300 million gap, and we identified we're looking at ways that we can fund that non-dilutive ways, so debt financing being the obvious answer. While there could be logic to say, well, in that environment, we should allocate all of our capital to funding that growth project, the reality is we've rewarded our shareholders significantly with dividends in the past. And I mentioned the $15 million capital raising. That was at 14 cents a share. Subscribers to that issue have received 13.5 cents in fully franked dividends since 2020. So we're proud of our dividend policy, and we're confident, as we were last year, that the profitability of the company will allow us to allocate a dividend, despite the fact that obviously we're looking to build a balance sheet to fund growth.
Yeah, and that financing, I know there'd be numerous ways you could go about it, but that circa 300 mil funding gap, like, is there any outcome, like, because it's a right to mine arrangement, like, would Sinosteel or Baowu potentially be financing partners to get involved in that is there any way, or it will be likely separate to them?
No, I think if you look at the pathway of our relationship with Baosteel, Sinosteel, their subsidiary in this part of the world, has been a foundation partner of Fenix. One of the sheds behind me at Geraldton Port we acquired from Sinosteel. Sinosteel had originally 50% of the offtake of the Iron Ridge mine. More recently, we acquired a right to mine 10 million tonnes, and when we successfully commissioned that mine, we then secured the right to mine the entire Weld range. So we've had an incremental relationship. Each time we forecast what the next step would be. When you look at the right to mine the Weld Range agreement, we looked forward and said that we are also discussing potential collaboration on Jack Hills, 100 kilometres to the north, 5 billion tonnes of iron ore, as well as financing and other opportunities where we can partner together. So those conversations are ongoing. The answer to your question is we've already indicated publicly that Baosteel are a potential and motivated funder of our growth. And we're also obviously continue to mature our financing arrangements. You saw that with the recent $44 million US facility we established with Resinvest. And we're in parallel looking at other opportunities as to how we can fund that growth. The other point I'd make is that having established the Beebyn Hub, we now have the opportunity to continue our current business at 5 million tonnes, soon to be 6 million tonnes a year, beyond the scope of the 3-year plan. We guided FY 26, 27 and 28 at 4.5, 5.5 going to 6. And then we are confident that there is a really high value, huge return on expanding our production to 10 million tonnes and significantly reducing our costs. However, if for some reason, and funding being one of them, that development plan is delayed, it's important to note that we can continue to operate the business at 5 or 6 million tonnes a year, continue to generate and bank cash flow while we evaluate financing development growth opportunities. So we feel like we've got control of our destiny. We've got a lot of levers. And I believe that we're demonstrating we've got a team across our mining, haulage, port, shipping, marketing, corporate teams that are developing a strong track record.
Yeah, very good. On the cost side, mate, diesel, correct me if I'm wrong, the diesel excise ends next Monday. Is that and we've talked about your hedging before, you've got circa 30% of your diesel hedged. I guess what impact would the other 70% have on the business at the moment?
Well, you saw that impact in the June quarter. On a C1 basis, it probably cost us $5 or $6 a tonne. It was purely attributable to the significant rises we saw in fuel prices related to the crisis in the Middle East. Pleasingly, towards the end of the quarter, we saw fuel revert back down, but then alarmingly, we're seeing it rise up again. We at one point were paying close to $3 a litre for diesel. the really sharp end of that crisis. We're used to a cost more in the $1.50 range. At the moment, we're seeing it at $2. So outside of the hedging benefit the delivered by that risk mitigant we put in place, the answer to your question is higher fuel prices result in higher costs for Fenix. And not just in our C1 cost, also we saw a direct impact on our shipping cost. And so that's something we continue to watch. And what we've done about that is make sure that we've got security of supply. And we're working very hard and confident that we will be able to announce commercial relationships which not only secure supply, but also guarantee preferential fuel pricing, given the volumes that we're now using, and particularly the volumes that we will be using as we ramp up our volumes.
Yep, and I guess on the other end, lowering costs on the shipping. So because you announced the partnership this quarter with Mirror Bulk, how much money are you? How does this arrangement work, and how much will you save on shipping with this partnership?
So I'll answer them in that order. How it works is the genesis of this concept actually is intrinsic to the way Fenix has taken control, and why we've been successful is our ability to control the key cost centres of our business: mining, haulage, port services in Geraldton. And although we focus on C1, which is the cost of putting a tonne of iron ore in one of these Panamax boats you can see behind me, the actual business is a landed, as you know, the index price is CFR, or a China landed price. And so a significant cost that effectively is a cost in our business is the cost of shipping outside of C1. And so the Mirror Bulk deal allows us to be more active in a similar way as we started in the haulage business. So the original joint venture between Fenix and Newhaul allowed us to understand the haulage business and look at whether we thought we could, deliver a lower cost business by taking control of it. Ultimately, that was demonstrated to be correct. We acquired the other half of the joint venture we didn't own. Then we acquired the entire Newhaul business, and we now operate that business, and in fact have improved on it from when it was a joint venture and when it was under Newhaul's control, mainly because we've been able to integrate it with the trade-offs and the alignment with the mining, the port, and the shipping side of our business. Mirror Bulk is a similar opportunity. We've gone out to a very well-credentialed global ship owner. They have a significant fleet of Panamax vessels, particularly the wide-bodied Panamaxes, which allowed us to set a shipping record out of Geraldton. And we've effectively established a joint venture with them where we've dedicated all of our shipping activity to them. The direct benefit for us will be that we get allocated the boats which will allow us to maximise draft. That'll lead to answer your second question about how much it'll save. We know that can save us as much as $2 a tonne on each individual ship by loading more tonnes into a ship, because the cost is the same. If you can get an extra 5,000 tonnes into a 60,000 tonne boat, you're paying the same. Although we talk about per tonne shipping rates, you're actually paying for the boat to deliver the tonnes. So we can see there's a saving there. The other element, similar to the joint ventures in haulage, is that we will see a profit split out of that shipping joint venture. Now, how much that is, we haven't guided publicly, Matt, and the answer is that you and I will have to wait and see. So we're going into this cautiously, optimistically. We know we've got the right partner in Mirror Bulk. We're confident we'll see a saving, and the joint venture will be justified by preferential access to the boats that are going to save us money in shipping and also efficiency, but also gives us a transparent look through that profit share at how much more we might be able to save out of shipping. And what that is, we'll just have to wait and see.
Yeah, I'm just looking at I'm thinking very bloody long term here, but considering the vertical integration you've got, is all of that just going to be for Fenix, or is that going to be for other people one day?
We've always been interested in the ability to provide services and generate returns for our shareholders. When we acquired the Mount Gibson infrastructure at Geraldton Port, we took on an obligation to move more than 4 million tonnes through the port, and we only had a 1.5 million tonne a year mine. So we went out and we bid for and won third-party haulage opportunities, third-party port services with other regional producers. So we understand both the advantage and the challenge of that business. Ultimately, what we're certain of is that we make the most money by moving our own tonnes. At the moment, every haulage truck that we own is dedicated, as you saw in that June quarter, to hauling highly profitable tonnes of Fenix, and that's the best use of them. Similarly, at Geraldton Port, we're confident that we continue to maximise our ability and putting pressure on our mining teams to ramp up so that we are using 100% of our available capacities. However, in shipping and in haulage, were that to change, we've demonstrated that we've got the capacity to diversify and to augment. But just to be clear, we're very confident that the best return on investment, and we've already demonstrated conclusively that we make the most money by hauling our own iron ore, by shipping our own iron ore. And the good news is we're sitting on top of 300 million tonnes of the stuff that all we have to do is continue to be efficient and continue to manage that integrated supply chain, ramp up, and we'll continue to make greater and greater profits.
Finish on the iron ore market, mate. There's a couple of, in January, I'm not sure if we discussed it last time, we had the benchmark iron ore percentage went to 61%. I think the facts I got is four out of five of the medium grade Australian producers are below 61, but you're sitting on 61. Is that worth a bit per tonne at the moment?
Yeah, look, one of the aspects of the June quarter for people who look closely is that Shine had a really, really good quarter. So there were a couple of things I've mentioned earlier, that the haulage team set a record, the shipping team set a record. The other tonnes that were really significant were increased tonnes from Shine. But what we know about Shine is lower grade, and a lot of those tonnes were lower grade material. And so fantastic, we made a profit on them. But obviously, we've always tried to target index pricing for our products. We had a $4 or $5 discount to the index during that June quarter, but that was because we were shipping lower grade material out of Shine. The good news is, as we transition to the Beebyn Hub, is that we're targeting over FY27 and FY28 to have an average grade of 61% or above. So that's great news. And then longer term, we're doing some work in the DFS for the Weld range around blending, around our selection of ore body, our management, to continue to maximise the grade. The other point I'd make, though, is that grade isn't the only determinant on pricing. And increasingly, we're getting a premium from our customers for the low deleterious elements and the consistency of product sizing, both in terms of lump and even our fines product. So in the June quarter, we did ship a 60% iron content product that actually got a premium to the index because of other factors. And so that's a real opportunity when you look at the Weld range, the Beebyn Hub, the Madunga Hub, the ability for us to blend our products both at the mining hubs, at the rail siding, at the port, to be able to maximise what individual customers are looking for at the scale that we operate, gives us confidence that we're going to continue to target the index as our price line.
Because you ship sort of around that 45% lump, and it says that lump premium is at a multi-year high. Why is lump premium high at the moment?
Well, it actually, perhaps picking up a comment I could have made to your question earlier about what we're seeing in the iron ore market. The iron ore market's cranking. We don't hear any pain from steel mills. There's demand for the low-grade products I mentioned we shipped out of Shine in the low 50s. And there's increasing demand, as you're identifying, for high-grade lump product and customers that are willing to pay a premium for it. So that's really good news. One, about the general health of the steel market. Second thing is it also indicates that there is an increasing appetite for consistency in the market. And yes, we're confident that we'll continue to produce that sort of lump and fines split. Conservatively, I think we're estimating 40% and 60, so 40% lump and 60% fines.
Yep.
But actually, historically, we've outperformed. And so one of the aspects of that is the control of our integrated supply chain. The ability for us to haul that iron ore 500 kilometres, unload it into the shed, load it into a boat and get it to a customer and preserve the quality they're wanting for that lump product is a testament to the care that we take and the control we have over that entire logistics chain. And to answer your question, the reason why there's a lump premium is this is a product that can go directly into a blast furnace. So the customer of a fines product has to pelletize it or process it, and that obviously costs value. Fenix lump, as our customers love it because they put it straight into their steel making process. Very low cost and very useful for our customers.
Yeah, and I guess with everything at the moment, with the big dogs like BHP with the Chinese one pricing, you had Rio moving to fast markets, you had Fortescue had cargoes held. What's happening in the world of iron ore shipping and paying at the moment? Is it affecting you at all, or your customers are pretty stable?
Yeah, Matt, I get this question a lot because obviously it's a key focus of what media is interested in iron ore, and my point would be not nearly enough given the scale.
Right here, mate. Right here.
I'm really glad you asked that question. We obviously there's a lot of focus on China, if I use that collective term, or the centralised buying group, putting pressure on BHP, now putting pressure on FMG around centralising their marketing and their control. The reality for Fenix is that we have not been affected by that at all. We're below the radar. If you look at the scale, these are miners that are producing hundreds of millions of tonnes a year of seaborne iron ore. We're really proud that we're at 5 million tonnes per annum run rate, and we're going to double that in the next couple of years to 10. But that really doesn't get on the radar of the scale of the inbound iron ore into China. And so we're not the focus of that centralised mining group. We have off-takers. We also have relationships with individual steel mills in China, and they're not regulated, and we don't see any influence from that centralised group. We've also got a lot of customers outside of China, which obviously don't have any association with that whatsoever. So our pricing model is really linked to the index, but it doesn't have any other focus or control or border tariff issues.
Yeah, very good, mate. As always, these are my longest interviews, and I love every minute of it, mate. I love talking iron ore with you. So, mate, thanks so much for coming on, and mate, great hustle in the business, and keep on punching. Everyone at Fenix, well done.
Thanks very much for your interest, Matt. And let me say, if you don't cut this interview and it goes out at the full length of what we've just said, congratulations to anyone who's listened this whole long time. I really appreciate not only your interest in Matt's podcast, but your interest in the Fenix story, and always interested in hearing from shareholders. We're very proud of what we do, and we look forward to delivering even better results in the future. Thanks very much for your interest.
Good on you, mate. Cheers, Johnny.
Thanks, Matt.